This is our Accounting Information Systems assignment. Today we will be talking about the revenue cycle. The revenue cycle is a recurring set of business activities and related information processing operations associated with providing goods and services to customers and collecting cash and payment sales. The primary objective of revenue cycle is to provide the right product in the right place at the right time for the right price. Now, within the revenue cycle, there are many cycles, which are sales order entry, shipping, billing, and cash collections. I will give an overview of each cycle, but we will go into detail in later slides. Sales order entry involves taking the customer's orders, checking in and improving customer credit, and checking inventory availability. Second is shipping, which involves picking and packing the order and shipping the order. Third is billing, which involves invoicing, updating accounts receivable. And fourth, which is the last cycle in the revenue cycle, involves collecting and processing payment from customers. Within these cycles, there are many threats that can occur. However, there are controls put in place to reduce the threats. This will also be discussed in later slides. We have chosen two companies, Belk and Dillard's, and we will identify some threats in each mini cycle and come up with solutions to reduce those threats, as well as how we will implement those controls.
First mini cycle of the revenue cycle is the sales order entry process. The sales order entry process consists of a total of really four activities. The first being taking customer orders, followed by checking for credit approval, and then checking inventory availability, and finally responding to customer inquiries. The final and fourth activity, responding to customer inquiries, it can swing either way. It can swing for sales order entry, but also it can be given to the marketing team as well. But for the sake of discussing the revenue cycle, we will include responding to customer inquiries into our sales order entry process. The first activity within the sales order entry mini cycle is that of taking customer orders. Which, while it may be pretty explanatory, there are a couple different risks and threats that go along with this activity. So first, you have inaccurate or invalid orders, and then it's followed up by the legitimacy of customer orders. And so, what each of these threats mean is that um, oftentimes you will have a customer order that might be incorrect. They might not get all the items that they ordered, or they might get something that they did not order, and so that costs the company more money because the the company basically has to replace that, or they might not ever recover that item back from the guest. So it's important to get the orders right the first time. And second, the legitimacy of orders. If a client, it goes back to if a client did not order a specific item or a specific um, order, sometimes you might have a customer that will get a order that they did not order, and so um, you will have another loss of funds and resources on that end. And so, a couple ways to combat those threats is by putting a couple of controls into place. One of those controls being completeness checks. Completeness checks allow for the company to automatically, through the software, require customers to make sure that they verify their order before they place the order and pay for it. Also, it requires them to make sure that their address is right, that their name and everything else is right as well. And then because that information is sensitive, you want to make sure no one goes in to be able to change that information because the inventory system knows based off the data that the customer has already put in, and that's and if that information, if anyone can just go in and change that information, then it kind of messes up um, the whole process of being able to send out the orders correctly. And so, as far as legitimacy of orders go, a great control that many companies do is they require signatures, whether if it's online, they require a digital signature, or if it's in person, they require a written signature. And what this does, it allows the company to verify orders right then and there at the point of sale, so you won't get that loss of revenue or that it will not cost um, by lowering the risk of sending out those products. Next, next in line we have the activity of credit approval, and so with the major threats of credit approval, you will have clients and guests that will try to order something above their credit limit inside retail stores or wherever they might be shopping. And so, a major threat of that stems from that is that you have an increased risk of bad debt um, due to the fact that if, let's say, a customer tries to buy something that puts them over their credit limit, if it goes over their credit limit, then more than likely they might not be able to pay it back. And so that means it's also a loss of revenue on the company's part. Furthermore, when tackling bad debts, um, you might have some conflict of interest within the sales staff, as the sales staffs are encouraged to, especially if they're paid by commission, they have to meet a certain quota, and if they are trying to meet those quotas, they might not necessarily care to really look into the credit limit. All their mind is set on is just selling, selling, selling. And so there are a couple controls that go along with that. And so one of them is the accounts receivable aging report. And so basically what this report does, the accountant would sit down, and so the accountant would sit down and they would go through the database, the customer database, and it will show how long a customer has been with the store. It will show what their current credit limit is. Basically, it allows the accountant to basically age um, the customer's relationship with the company. And so, based off that, they can then make decisions on whether to raise that customer's credit limit and make a better judgment on who should be allowed to um, go above and beyond that credit limit. And so that leads into our separation of duties. Like I said before, you get conflict of interest if the sales staff has to authorize a um, higher credit limit for customers. They're going to be, since they're incentivized to sell, then they're not going to pay attention to whether or not that customer actually needs to have a higher credit limit. And so one of the controls is to separate that duty. So instead of having the sales staff be responsible for authorizing higher credit limits, you will pass that on to a different manager within the sales staff. So next we have the checking of inventory availability. And so this kind of falls into making sure that the inventory is actually there to sell. And so a big problem for certain stores and companies is that those two major threats are stockouts and excessive inventory and stockpiling. And so, as far as stockouts go, it basically just means that the company is running they're either running low on inventory or the inventory is just already out of stock. And so if inventory is not there, then if someone places an order, it ties back into the fact that those orders might not be completed, that they might be inaccurate once they get them, and so that's why you need to have a stable and um, very streamlined inventory tracking system. And vice versa. With excessive inventory and stockpiling, you don't want to have too much inventory on hand, because that could also lead to um, lost revenue if items are not selling and they're constantly being ordered. Then um, the cost of goods would come to overcome the revenues that you would get. And so, in both cases, it can cause um, orders, whether online or in person, um, to be invalid. And that might cause the customer to go to another competitor. And so you really just don't want that. And so, we have a few controls that that we have in place to battle those major threats. And so one of those are the RFID tags. And so by using those RFID tags, you're able to constantly um, keep track of inventory, but um, that may not always work. So it's important to always um, complete physical inventory audits as well. And so, what those physical inventory audits will be able to do is basically just a supplement for the RFID tags, just in case that the tags miss any inventory, or it might be slightly off due to something that might have happened in the store based on like sales returns and all of those sorts of things. And so also another control that can be put into place are the usage of sales forecasts. And so sales forecasts are usually done by the accountant. And so basically, what these sales forecasts do is they basically take what a company might have already sold or what they're selling, and then it predicts going forward how much inventory is needed, and it allows the company to basically keep keep track of inventory that will sell and won't sell, so you don't get those stock outs and excessive inventory and stockpiling. So the final activity under the sales order entry process is the process of responding to customer inquiries. And so for this process, you basically have two major threats, and so which are pretty common. So you would like to have it's the accuracy and promptness in responses, and then the ease of contact for customers. And so for customer inquiries, you would like to get back to your customers as quick as possible and with accurate answers, so that you might solve their problem. Um, because the main thing that you are trying to build with customers is loyalty. You want your customer base to be loyal to your store, to your company, so that they always come back. And so the one of the main things that you do with this is you want to make sure your responses are quick, timely, and accurate. And you also want to make sure that it's easy for the customers to contact you in case they have a problem. And so you have a couple of controls that will help with these threats. Um, so you have the use of websites and instant messaging programs. And so most often, companies will put into place a website, like Q&As. Um, they will have instant messaging where you can message a chatbot and be able to get answers quickly. And also, another control is that you would like to contact the customers not only post sales but also pre-sale, so that they might return, and that it shows that the company really does care about the customer. And so those are just a couple of controls that you will like to keep in mind, to make sure that customers are happy and that they are going to keep coming back. So to use a couple of examples, we'll use Belk and Dillard's. Belk is a fairly large retail department store, and so with it being quite as large as it is, there's much room for error in terms of fulfilling customer orders and meeting inventory needs, and also making sure that customers are well taken care of and that they're contacting those customers. So to combat the risk of inaccurate orders and insufficient inventory, Belk actually um, paired with IBM to use a software known as SaaS Analytics that automatically keeps track of each order made, whether in store or online, and it automatically and simultaneously orders inventory based off the sales order. And so Belk also consistently checks its customer base for opportunities in raising credit limits for clients as well. Since Belk takes monthly cash in the form of debit or credit, the need for an aging accounts receivable report is quite unnecessary, since Belk usually gets their um, that cash asset or that cash equivalent pretty quickly. So likewise for Dillard's, its sales order entry process, they have also evolved, and they now utilize a logistics company known as Logistics. Um, Basically, Logistics is a logistics company that allows for dealers to not only track inventory but also um, allows for a seamless or online ordering and shipping experience. So once customers order online, logistics works to make sure it immediately goes straight to a carrier. It goes from the warehouse straight to the carrier, and it's all pretty seamless. And the customer actually gets a tracking number quite quickly. And what it also does, because it tracks inventory um, through through the software, it allows dealers to also order more inventory based off those sales orders. Dealer also uses RFID tags alongside logistics to keep track of inventory within the stores and the e-commerce warehouses, which lowers the risk of stockpiling and stockouts. Dealers also makes great use of instant messaging on this website, similar to Belts, which I mentioned earlier, as far as the chat box and the Q&As that they have on there regarding shipping and ordering. Um, they also quite frequently check customer their customer database to allow for credit limit increases, and the department store also regularly contacts its customer via survey emails to make sure they're reaching out and contacting their customers, both pre-sale and post-sale. But there is room for improvement, and we'll discuss that also as well. So where can these two retail department stores improve? As I said before, they both make use of similar software systems that automates the process of taking customer orders. But I believe even bigger solution lies ahead in the form of customer inquiry responses. Um, as they rely on internet to make seamless experiences, I do believe that there's much to be desired as far as um, contacting customers and reaching out to customers. In the cases of both stores, the concept of taking customer orders was emphasized, and so they put a lot of emphasis on making sure that customers get their order right and making sure that the orders actually get to the customers. However, I believe that um, there's still quite a large portion of the sales order entry process that revolves around the concept of contacting customers. Um, as things stand right now, both companies rely on the customer to come to them with inquiries first, and so you have a lot of responsibility put onto the customer on the guest to reach out. My proposed solution is to revamp their customer contact style, similar to the way they revamp their customer order taking process. And so, if they can put a larger focus on retaining customers by contacting them um, and engaging with customers, taking the first step first, whether that's via call, text, or email. I think it will be a great idea for both departments to reach out to customers and clients first, and just show that they really care, because at the end of the day, the sales order entry process is based on the fact of building that rapport and that loyalty with their customer base. And so, if both Belk and Dillard's were to combine um, the software system the way that they have for taking customer orders, and using that also in contacting customers. Um, for instance, if a customer hadn't been to Belk in a while, the system they should have a system where Belk has a customer representative contact that customer and let them know about new and exciting deals, perhaps. It would help a lot for customers not to just go to them with just an inquiry, but if the company came to them and showed that they cared about the customer's business, then I believe that that the customer is more likely to return and to stay loyal to the company. And that concludes the sales order entry process.
So I'm going to be talking about shipping, which is the second activity in the revenue cycle. This process consists of two steps. One, picking and packing the order, and two, shipping the order. These two processes are performed by the warehouse and shipping departments at Belk and Dillard's. To begin the first step of picking and packing the order, the picking ticket created during the sales order entry process is needed. Warehouse workers use this ticket to identify the product and quantity to remove from inventory. The inventory is then moved to the shipping department. To improve inventory efficiency and accuracy, Belk and Dillard's both use RFID tags to track inventory movement. RFID stands for radio frequency identification. These tags use radio frequency to search, identify, and track the movement of inventory. These labels store important information such as serial numbers to ensure proper storage and routing of inventory items. The second step of the shipping process is shipping the order. The shipping department at Belk and Dillard's are responsible for counting the inventory and ensuring it aligns with the picking ticket and sales order. Once this is complete, the items are distributed to customers. Belk and Dillard's use common carriers such as FedEx, UPS, and USPS to distribute their orders to their customers. A potential threat to this process is shipping the wrong items. Shipping errors can cause customer dissatisfaction and deter them from ordering from your company again. To solve this issue, ERP, which is Enterprise Resource Planning systems, should be put in place. These systems check order quantities and item numbers to ensure the correct inventory is being shipped. If there are any discrepancies, a warning will display so the issue can be corrected by the company before their items are shipped to the customers. Potential threats to the shipping process include picking wrong items or wrong quantities and theft of inventory. Belk and Dillard's avoid the issue of picking incorrect inventory items by using the RFID tags. Both companies have implemented these tags throughout their entire inventory to improve order fulfillment. RFID tags practically eliminate errors concerning picking inventory. To avoid theft, these companies should keep inventory in a secure location, restrict access to it, and make sure that inventory transfers are documented. Limiting the number of employees that come in contact and deal with inventory will likely reduce theft or the potential for it. Also, shipping and warehouse employees should sign off on the document accompanying the goods when they are being transferred. This allows for the tracking of the items and shows who had them in their possession. Belk and Dillard's do a good job of shipping orders in a timely manner to ensure customer satisfaction. Both companies have policies in place concerning shipment times and do their best to get orders to customers within 2 to 7 business days. Overall, shipping is an essential process in the revenue cycle, so it is important to perform the steps correctly and accurately.
Billing clients is another process in the revenue cycle. It is important to know how to protect each process against threats. Threats in the billing cycle include failure to bill, billing errors, posting errors into accounts receivable, and incorrect or invalid credit memos. However, there are several controls a company can put in place to avoid these threats or correct any errors made. For instance, Belk and Dillard's are two higher-end department stores that handle threats to billing similarly to that of retailers. The first step in the billing process is the sales invoice. This lists the quantity and price per item that an individual wants. A company might prefer to rely on just the shipping information rather than both the sales invoice and the shipping information. So what actions can a company take to prevent a client from not being billed? When shopping online at Belk and Dillard's, the only way a customer can receive an item they want is to purchase it. A customer must select the items they would like to purchase, and then the company will present an order summary before the customer can proceed to pay with either a credit card, store credit, or PayPal. Both Dillard's and Belk have these controls in place. A customer must pay, confirm their shipping address, and their items in the order before the companies can recognize the transaction. Sometimes errors still occur, such as billing errors. This could be charging the wrong price or charging customers for incorrect items. To limit the occurrence of these errors, both Belk and Dillard's require the customer review the price and the items they've selected before they confirm their order. However, if an error does occur, both companies allow for customers to return their items for full refunds as long as they have all of their order documentation, such as the shipping confirmation and the transactions invoice. Errors in accounts receivable is also another threat. I believe both Belk and Dillard's use the open invoice method. This method is where the accounts receivable is maintained by customers paying the individual invoices, which allows for a more uniform flow of cash collections. While each company has a large amount of customers, these customers tend to primarily shop at other businesses. Both companies are also more high-end department stores that people are not consistently shopping in. That is why I believe each company maintains accounts receivable through individual invoices. The balance forward method utilizes monthly statements to maintain accounts receivable. This method is typically used by companies with consistent customers, such as utility companies or credit card users. When a customer chooses to return an item or they are given an allowance for damaged goods, their account is credited and a credit memo is issued. A copy of that credit memo is then sent to accounts receivable to adjust the customer's account. A copy is also sent to the customer. If a customer's account is credited for an incorrect amount, it can deter them from purchasing from the company in the future. Therefore, the company would lose sales, so it is important that the company ensures that the credit memos match up with the current invoices.
The fourth and the final mini cycle in the sales revenue cycle is cash collection. Cash collection, as you will see, is perhaps one of the most important processes of the revenue cycle. This is where the collection and the process of payments from customers is made. It's where cash is finally collected for services rendered, and it's also where data about customers is processed and sent to the right employees. As with any of the cycles that we have discussed, there are threats. We discussed the threats to shipping, billing, and so on in the previous slides to this video, but now we're going to discuss the threats to the cash collection. Number one, the biggest and perhaps the most detrimental threat to cash collection is theft. Theft is the stealing of another person's property or an entity's property. In the case of our cash collection cycle, it's where cash is being stolen by an employee. This is harmful and detrimental and very serious for many reasons. One, it's illegal. Everyone should know that stealing is wrong and illegal. It causes headaches for everyone involved. It causes the organization to lose out on assets, and it causes the organization to have to get their paperwork and everything else. The person who steals will most likely go to jail, which is not good, and it can be emotionally draining for everyone involved. On a financial side, it can also cause financial information to be inaccurate. Say an employee steals cash and no one finds out, and they still record the cash being deposited as what it was before they stole the cash. That's causing your cash balance to be off. It can cause your accounts receivable balance to be off, and it can cause your liquidity ratios to be inaccurate. And this is important to financial investors and users of financial statements who are looking at the statements to make decisions about investing in a company. They might invest in a company that's not as liquid as they think it is because someone has stolen cash. Also, theft harms the revenue cycle. Companies have worked so hard in the revenue cycle to finally collect the cash they are deserving of, and if an employee steals it, that's not good because the company's missing out on what they have earned and what they've worked so hard for. As you will see later, though, there are controls put in place to reduce the risk of theft, and we are going to cover that in a few of the next slides. As you will see here, I put this infographic in here just to show that theft is way more common than you think it is, which is sad. 75% of employees have stolen from their employee at least once, according to this. So you can see that theft is really, really serious. The second threat to the cash collection cycle is cash flow problems. Every company must have enough cash on hand to operate. This is plain and simple. If you don't have cash, you're not going to be able to operate and will probably have to close down doors of your business. The reason cash flow problems are a threat to the cash collection cycle is because cash inflows and cash outflows can be unpredictable. And the risk of not having enough cash on hand it's in existence. If a company fails to have enough cash on hand, the company will have to either borrow money or they will have to cut down production. If they borrow money, this will lead to ratios being unfavorable. It will lead to a higher debt to income ratio, which can cause you not to be able to get loans later down the road that you actually might need. It can also lead to lost revenue. If you have to cut down on production, you're not going to sell as more, you're not going to make as much, and that can lead to lost revenue. So having worser financial instruments and lost revenue is not good. And again, there are controls put in place to limit the risk of cash flow problems, and we're going to discuss those later. So I've mentioned controls, and you might wonder, what are they? You've been saying this word over and over, but I have no clue what you're talking about. Well, a control is I would say a process put in place to limit or reduce the risk of the threats that we have mentioned. And they serve a couple of purposes. One of the purposes of the controls we are going to discuss is to increase the speed of the cash collection process. That also kind of ties into our second purpose of the controls, and that is to reduce the risk of theft and cash flow problems. I say they are correlated because if you're increasing the speed of cash collection, you're most likely limiting the risk of cash flow problems because you're having a faster income and stream of cash. So, I've mentioned controls, and now I'm finally going to give you the examples that you want and that you want to know about. If you will see, I have listed controls to combat theft, and I have listed the controls to combat cash flow problems. They share many, many, many similar controls. In fact, there's only two different ones that I put on here that are separate, and I'm going to talk about those first. The first one I want to talk about is under the controls to combat theft, and that is the segregation of duties. A segregation of duties is perhaps the most effective control put into place to combat theft. And what a segregation of duty is, it simply means you're not going to have one employee doing several duties. You're not going to have the same employee collecting cash and also be an accounts receivable clerk, because that can lead to opportunities for embezzlement. You're not going to have a person who collects cash also being charged for credit memos, because again, that can lead to embezzlement. You're going to separate these duties, and you're going to have two people do individual tasks. Example would be a customer sends in payment. They send in their payment information along with the check. You're not going to have the same person get both of those. When it comes in, you're going to have the check go to a cashier, and you're going to have the remittance data sent to the accounts receivable clerk. That is a good example of segregation of duties. If both went to the same person, that person could pocket the cash, and still they could fluctuate the accounts receivable account, and that's not going to be good. When it comes to controls to combat cash flow problems, one of the better controls is a cash flow budget. A cash flow budget is simply just a estimate of your expected cash inflows and what you expect to pay coming up, like your outstanding accounts payable. It helps control cash flow problems because you can better predict where you're going to be, how much money you're going to need to borrow, and so forth. If you have a surplus of cash, it also can help you determine where you want to put the excess cash to grow more money and investments and things like that. Now I'm going to talk about the similar controls. You'll see there's a thing listed called lockbox arrangement, and what that is, a company has a PO box sort of thing, and they have their bank in charge of picking up their checks and sending and processing the checks and sending over the information to the company. This helps crack down on theft because the bank is in charge of the checks. It never goes to an employee's hands at the company. And it also helps combat cash flow problems because you're not waiting on checks to come to the company. They're going straight to your account through the lockbox. Another similar control is an EFT, or an electronic funds transfer. That is where a person authorizes their bank to transfer funds to another person's bank or company's bank. This combats theft because, again, an employee is not receiving the cash, and it speeds up the process combating cash flow problems because it's almost instant. It might take a day or two, but the cash is being transferred automatically into the company's bank. Remote deposit capture, that is what we refer to as a mobile deposit. It's where if the company does receive checks in the mail, they automatically deposit it using a device into their bank account digitally. That helps combat theft because as soon as it comes in, you're automatically putting it in there, and that also helps with the cash flow problem. You also see financial electronic data interchange. That is where a person sends in, that's where two banks, they do ETFs and EDIs. They're transferring funds, and they're also sending the appropriate remittance data to the company. That helps crack down on theft because, again, EFTs, money transfer from one bank account to the other. Employees don't touch it, and the data about the remittance is being sent through the bank to the right company. Finally, we're going to talk about credit cards. And credit cards are great because they combat theft because, again, the cash never goes to an employee or anybody who doesn't need it. It's straight into the company's account through the scanners and readers at the company. And it also, again, speeds up the cash flow problem because it's instant. The cash from the credit card company, or the money from the credit card company, is sent to the company's account. So now we're going to talk about scenarios. We're using the company's Belk and Dillard's. And in scenario one, there's theft at Belk. First, I'm going to talk about Belk. We all know that Belk is a retail department store located across the United States. It's owned by Sycamore Partners out of North Carolina, and they specialize in providing high-quality clothing, shoes, jewelry, accessories, and household items to consumers alike. Because of the nature of its business, Belk collects cash when sales are made via in-store or online at the time of sale. Belk really does not have an accounts receivable because, again, the nature of its business, when you go in and buy something from Belk, you're going to either pay them via cash or credit card. In this scenario, we're going to say there is an employee who's in charge of making deposits for Belk through the cash. And this employee is falling on hard times and is facing many financial pressures in their personal life, and they decide to take some of the cash on hand, the petty cash, out of the bank bag as they go to make the deposit, and they cover this up because they're also in charge of journal transactions. This is an issue. If Belk would properly put segregation of duties into place, this would never happen. So that is the control I would recommend in this scenario. Scenario two, we're talking about a cash shortage at Dillard's. Dillard's is like Belk in many, many ways. It's a retail department store, again, located in the United States. One difference is it's a publicly traded corporation, but it's ran by the Dillard's family. They probably own shares, but they also are on the board, and they also specialize in the same products as Belk, and they also collect cash at the time of sale. In this scenario, Dillard's has fallen into a cash shortage. They don't have enough cash on hand to operate. They can't buy inventory. They can't pay their employees. They've fallen on hard times. This could have been avoided, and the control to fix this would be a cash flows budget. If they would probably do a cash flow budget, they would they would estimate the amount of cash inflows they expect. They would see what they're probably going to pay out in the next month or so, and they would predict what amount they would need to borrow to stay in operation. That is the control I would recommend in this scenario. And that wraps up the cash collection cycle.
In conclusion, there are many threats within the revenue cycle. We identified some threats and solutions for Dillard's and Belk for each mini cycle that made up the whole revenue cycle. The revenue cycle can be confusing since it has many components to it. However, I hope this presentation helped listeners understand the revenue cycle.